Hello, options traders. Welcome, everyone. I was giving a presentation the other night on covered calls, and I had a number of traders asking, how do you know which strike to write? And it's a great question, so I thought maybe it would help everyone in this group as well. Now, keep in mind what I'm about to show you applies to any option strategy where you are selling options. So it doesn't matter if it's a covered call, vertical spreads, horizontal spreads, or time spreads, calendar spreads, double diagonals, double calendars, you name it. If it is a strategy where you are selling an option, the key point that I want you to get from this video is that you want to make sure that the option is contributing a significant portion of your gains. So I'm going to use the covered call as an example, and I think most of you know that the strategy is one where you own shares and then you're going to sell a call against those 100 shares. So they could be shares that you either just purchased or maybe you've had in your account for some time. But when you sell that call, you have the obligation to sell those shares for the strike price. Now, it's really a potential obligation because it depends on if the long position, the person who bought that call, actually exercises. But the main thing to understand is that as soon as you sell that option, you do have a potential obligation to sell those shares. So, for instance, let's say that you buy shares of stock for 100 and you sell the 105 call for $1. By selling the 105 call, you've given somebody else the right to buy those shares for $105 between now and any time through expiration, no matter how high that stock price might be. So if those shares are trading for 115, you might end up getting assigned and have to let those shares go for 105. Of course, you've got a lot of different strikes to choose from. So which ones should you consider? Well, generally speaking, you've got three basic categories. You have in the money, at the money, and out of the money. If you sell an in the money or an at the money, the most you can make is the time value. Yeah, that option might have a very big price on it, but a lot of that is also intrinsic value, and that is not contributing to the strategy. So remember, in the money and at the money, the most you make is the time value. On the other hand, if you sell an out of the money, you can make the time value, but you also might make some capital gains, and that's because you're allowing some room for that stock price to run. So in all cases, you always get the time value at a minimum. But if you're selling out of the money, you might also get some capital gains. So remember, if you're considering these strategies, you have two sources of potential gains. One is the time value, and the other is capital gains. And again, that only comes if you're selling out of the money. So again, let's say our stock is at 100, we sell the 105 call for $1. If you get called out at 105, 5 of those dollars were from capital gains. It had nothing to do with the sale of that call. Why? Well, even if you didn't sell the call and the stock went to 105, you still would have made the $5. The call option contributed nothing to those $5 worth of gains. However, because you also collected $1, you captured an additional dollar's worth of time value. So in this example, the most you could make is $6. But 5 of those dollars came from capital gains, and only $1 came from the strategy. Now here's another alternative method of coming up with those. I find it a little bit easier. But just understand, if you paid $100 for the stock and you sell the option for $1, that your effective cost basis is $99. You spent $100, but you got $1 back. So think about this. If you had spent $99 for the shares and you ended up selling them for $105, you made $6. But only one of those dollars came from the sale of the call, so therefore the remaining $5 must be from capital gains. Now, here's where the problem comes in for most traders. Most traders get too focused on the capital gains, and they like to sell these far out of the money calls because they think that that's making the strategy more valuable. So for instance, if the stock is 100, they might sell the 120 strike for 10 cents. And they say, oh, I could make $20.10 from the covered call. Well, not really. You only made 10 cents from the covered call. The first 20 of those dollars came from the capital gains. It had nothing to do with the strategy. But they seem to lose sight of that. And what they do is they want to sell these far out of the money options so that they have a very low chance of getting assigned. And that's fine, but don't sell it for just 10 cents. Because now you are sealing off all of your upside potential in exchange for only 10 cents. So again, the main point of this video, be sure that the option is contributing to the gains. And by that I mean a significant portion. And yeah, I know that's subjective, but don't let it contribute 1% or 2%. I'd probably try to get at least 20, 25% of the total gains coming from that option. So here's an example. Here's some recent quotes from Home Depot, and you can see the stock is trading here for $214.28, and I'm going to use these prices right here as the mark. Now let's take some of these strikes here and swing them over to a table just to make it a little easier to see. So again, we've got the stock at $214.28. Let's take a look at the 202.50 strike. It was trading for $12.62. And again, it looks like this is bringing in a lot of premium, but you're not making $12.62 on a 214 base. And that's because you have the obligation to sell those shares for $202.50, which would be a big loss. And of course, that's being reflected by the intrinsic value here. So the amount that you're actually making is the time value, is 84 cents. And as I talked about on a previous slide, that's the most you will ever make. Another way we can figure it out is to say that your cost basis is $201.66. How? If you paid $214.28 and you sell the call for $12.62, that gives you an effective cost basis of $201.66. And if you end up selling those shares for $202.50, that gives you an 84-cent gain. So notice that for all of these rows where they are in the money, which are all of these down to the 212.50 strike, that the amount you can make here, 84 cents, is the time value. 92 cents of total gains is the time value. Both of these columns match all the way down to the 212.50 strike. And that's why you can see in this final column here, I'm looking at it as a percentage. 100% of your gains are coming from the sale of the option. But what happens when we start going to slightly out of the money or even far out of the money? Well, let's jump down here to the 215s. The 215s were trading for $3.22. It's all time premium, and that would give you a cost basis of $211.06. But notice that your total gains are slightly higher than the time value. Time value is $3.22, but I could make $3.94. Why? Well, this option is slightly out of the money. If we pay $214.28 for the shares and we let them go for $215, we're making another 72 cents of capital gains. And so that's where this extra 72 cents is coming from right here, which is being shown right here, 72 cents of capital gains. So the one thing that we want to look at is of the $3.94 total gains that I can make, how much of that is coming from the option? Well, $3.22 of it. And that's 82%. So the 215 strike is contributing a lot to your potential gains. And so that would be one that's worth considering. But notice when we come down here, let's say to the 225, this is what most traders like to reach for. Because they'll say, oh, I could make all of this money from the capital gains. Yeah, but the option's only trading for 58 cents. The most you're going to make from the option is 58 cents. And it does lower your cost basis a little bit to $213.70. But if you end up letting them go for $225, yes, you could make $11.30. But that's primarily from the movement in the stock, not from the option. So of the $11.30 that you could possibly make, only 58 cents of that is coming from your strategy, or 5%. $10.72 is coming from the movement in the stock that would have happened anyway had you not even sold the call. So when you're starting to see very small percentages like this, even 10, 5s, and 3s, they just don't make a lot of sense from a strategic standpoint. This 20% one is probably on the border, but certainly this 217.5 here, generating 40% of the gains, would be one that's worth considering. But the main point that you don't want to do, and again, it's the big mistake that everybody does, is they want to sell something super far out of the money, way out here, for only 10 cents, and yet they get lured into thinking that it was the strategy of the covered call that generated all these gains. Remember, the most you're going to make from the sale of the option is the time value, and that's why you want to pay particular attention to this column. So for this 227.5 strike, if you're only making 37 cents, and of the total 13.59 you could make in capital gains, only 3% is coming from the option, why bother? And yet that's the one that most people would reach for. So I hope that will help you in making future decisions, not only for your covered call, but anytime you are selling an option. For those who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsato-z.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.